Welcome to our Croner Taxwise webinar programme. If you've got any questions at all, make sure you call the tax or the VAT advice line. If you're not a client, give us a call on the number on the screen.
Hello and welcome to this webinar for Croner Taxwise. My name is Mark Morton, I work for Mercia Group, and I'm just doing a short presentation today to discuss what are referred to as the off-payrolling rules. But effectively, in very simple terms, IR35 for public sector. What I should, though, and probably contradict myself initially, let's be clear, it is not IR35. What we have at the moment in this sort of area is the IR35 rules that were brought in 15, 16 years ago. We then have the agency rules, we then have the managed service company rules, and we then, as a final strand, have now these rules which are applying, well, I would say, rather than off-payrolling, I would say to public sector contracts. And the reason I make that point is the IR35 rules ultimately, and these rules do give you different net results. So I think that's worth bearing in mind. It isn't IR35, it's just another thing in a similar area. And what the government are effectively saying, if I keep it nice and straightforward, is that if I have a service company and work on a public sector contract, of course public sector could be NHS, could be MOD, local government, BBC, quite amusingly HMRC, Ministry of Justice, blah, 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 any of that sort of contract, then what is going to happen, and I suppose the start date is important, for payments from the 6th of April this year. It isn't new contracts, it's payments that are made from effectively the public service entity towards my limited company from April. The potential is that they will have to be pay as you earned at source. So for the first time that most of us will ever have seen, a payment will be pay as you earned even though it's being paid to a company. If, stripping out all those intermediate bodies, I am really, for tax purposes, an employee of the public sector. Now, that's the most important thing, part of this. It requires a judgment, and the legislation requires that the public sector entity make a judgment as to my tax status. What appears quite clear at the moment is they are not making a judgment, they're just doing a blanket approach, not an individual approach, and saying, you're caught, and I'm sorry, from April, we operate pay as you earn on that, and we also account for employers' NI. That is not what the law intends. What I can do as the person on the receiving end of this is two things really. The government have created an online status checker, so I could go online, I can go online right now, I can type in my information, I can answer truthfully of course, and if that comes out and says you are not caught, the way to stop this as soon as possible is to send that report back to the government department and say, please note, I am not caught, do not do this. So I think that's really important right up front. The second element of this is that you can also, as the person on the receiving end of this, write to the public sector who've made that judgment and say, actually, you need to explain to me why, and you have 31 days to answer me. Otherwise, I will tell the revenue and you will get a penalty. So I think in the short term, if you do that questionnaire, you can add a bit of pressure back onto the public sector and say, no, 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 do not do this. It is not a done deal, this. So that is really something that needs to be gotten onto, whether by yourselves or the clients, as soon as possible. Other implications of this, I suppose, just to draw the distinction, it isn't IR35, so if you are caught, then what happens is you don't get a 5% allowance on the payment. So if I am paid 100 grand a year, there will be no allowance against that. VAT is ignored. If there are any materials in that 100 grand, you'd take those off, and then in simple terms, what you do is pay as you earn the balance. And interestingly, the revenue envisaged the public sector operating an old-fashioned P46 kind of joiner statement, so sending me a form and saying this is my only source, allocate me the personal allowance, if not operate BR, whatever it may be. They envisage that going on. Of course, if they don't do that, I suspect they'll be on 0T, but the point I'm trying to make here is just because something is pay as you earned up front does not mean it is the end of it. Because what will then happen to follow the process through, and I should explain as we follow the process through, it may be there are other bodies in the middle. If there are multiple bodies, an agency, multiple agencies between my company and the public sector still make the judgment that I'm an employee, but they then have to tell the agency, and the agency will pay as you earn the payment. So it's the last payer in the chain to my company which operates pay as you earn. So in that situation, the public sector would tell the agency operate pay as you earn, because the agency are then picking up the 13.8% liability as an employer, if nothing else. That explains the mechanical situation. Where does it leave my company? If I go back to the 100 grand, the 100 grand will come in as turnover. The tax and employees NI that has been deducted would then have to be netted off within the formal account somewhere, because clearly that's never going to be receivable. You will then have any other company expenses coming into that set of accounts at that stage, but, and the big but, that will leave you with a corporation tax profit at that stage. You are then allowed, to the extent, let's say 30 grand's been deducted at source of that 100, I can then draw the balance of 70 from my company, and in simple terms, whether I draw that as so-called salary, although why would you bother, or dividend or employer pension contribution, it won't matter, I can take that money out, and up to the net figure of 70, there will be no further liability on me, because on my personal tax return, what will be going on is the 100 of salary, the tax and NI deduction, and I'll be returning that. And of course, that means, of course, if only basic rate's been deducted on 100 grand, I still owe a considerable amount of personal liability in respect to that salary. The second thing to watch about that facility, it's a case one adjustment, but you only get the deduction as and when the money is paid out. So of course, you start to create timing issues here in terms of, particularly, I mean, if you keep it nice and simple, you have one income for the company and it's all caught. Unless you draw that money out in the same year as you are taxed on it, then you start to get mismatches. So the government are almost saying, if you are caught by the pay as you earn, you've got to take that cash out regularly. Otherwise, if you don't take it out, you don't get the tax deduction, which of course will take you back to a fact that you still have relatively high corporation tax profit and hence corporation tax liability. So the rules need some thinking about, it has to be said. Another consequence of being caught by these rules, the government changed the travel and subsistence rules last year, and in this situation, what it would potentially mean is if I have been travelling from home to the NHS on an 18-month contract, potentially on the old rules, that would be an allowable journey. On these rules, what that will do is make that journey for 18 months effectively into my ordinary commute. And hence there is a knock-on consequence if you're caught by these rules to your travel and subsistence, or the tax relievable position of your travel and subsistence. So the rules are not straightforward. They take a bit of thinking about. The other thing that's floating around here is I've seen a number of offers go into an umbrella company. I'm honestly not clear how that moves you forward. Potentially what it does do is move you into the managed service company rules. And I think what that would ultimately do, it wouldn't change the pay-as-you-earn position. If you're caught by this sort of arrangement. But what that would potentially do is move the employer's NI from the NHS, from the agency, wherever it may be, onto my company personally. So my personal feeling would be, do not be tempted into an umbrella structure, because if I'm honest, I don't see how that moves you materially on. It does beg a question, do we stay limited? The commercial rationale, of course, may be that the NHS still want you as a limited company, because ultimately they do not want the danger of you ever being reclassified as an employee to them, particularly if an agency's piggy in the middle here. So would there be any point having a limited company? I suspect possibly not. Commercially, can you do without it? The answer may well be no. So it's a pretty complicated set of rules, pretty painful set of rules. Bear in mind it won't become law till July, so we are dealing with hypotheticals at the moment. I think the thing to concentrate on at the moment is that online tool, make the NHS or whoever it is tell you precisely why they think you're caught, and then argue backwards from there and try and stop this before it starts. Easier said than done, but I do appreciate that, but I think in the short term that's possibly all you can do to try and stop this. So I will let you get on and start doing that right now. Thank you.